Good morning, good afternoon. If you can hear me, go ahead and send a chat in. Just want to make sure the sound is ready and working for you. Right now at the top of the hour. Hello, John, Salam, David. Good morning, good afternoon to you. Yes. Hopefully you had a good weekend. My weekend, I actually went down to Las Vegas. Son had a soccer tournament, and Utah was really nice. That's where I live in Salt Lake, and left Salt Lake to go down to Las Vegas. Thought it was going to be unbelievable weather, and it actually turned out to be rainy, overcast. Brought 2 pairs of sunglasses, did not use a single one of them. Learned over the weekend life is not fair. All right, with that said, just making sure the sound is working. All right, hello, and good morning, good afternoon to everyone. Let's go ahead and get started. We welcome you to the presentation on covered calls and cash secured puts. And with that said, let's go ahead and actually just jump right into the disclosure so we can actually talk about the markets and some what we're going to discuss here today. Remember, the options are not suitable for all investors. Or special risk inherent to option trading may expose investors to potentially rapid and substantial losses. Okay. Also, understand that market volatility, volume, and system availability may delay account access and trade executions. Also, with that, understand that supporting documentation, okay, for any claims or comparison stats and other technical data will be supplied upon request. Also, transaction costs, very important to actually understand those when evaluating any options trades. And also, with that said, futures and futures options trading is speculative, not suitable for all investors. Forex trading involves leverage. Futures and Forex accounts are not protected by the SIPC. And also, futures and futures options Forex trading services provided by TD Ameritrade Futures and Forex LLC. In order to demonstrate the functionality of the platform, we're going to use actual symbols. TD Ameritrade is not making recommendations or determining suitability. Any investing decision you make in your self-directed account is solely your responsibility. Past performance of any security or strategy does not guarantee future results or success. And also, with that said, remember that delta, gamma, vega, theta, very important terms we're going to discuss here today. We're going to talk about the sensitivity to the price, volatility, and the sensitivity to time decay, whether you're collecting and or paying. Also realize that probability analysis is theoretical in nature. It's not guaranteed. Okay? And with that said, let's go ahead and get started here today. Now, as I was spending the weekend down in Las Vegas, I had some really time to think about this class, and I was thinking about, I know you're thinking, are you kidding me? Yes. Okay? Trading is always on my mind. Okay? And so I was thinking, what is really the purpose of like covered calls and really cash secured puts? You know, I think everyone could probably, I don't care if you live well below your means or you like to spend money, it really comes down to income, okay? Making income, okay? The thing with this class is really, we're trying to really also, through this class, through doing covered calls and cash secured puts, is increasing the probability. It does not mean that it's 100% probability. There's a certain probability associated with it. Those probabilities can change, but it's really trying to increase the likelihood that we can make money from different directions of trend, okay? Now, when we try to go for that income, okay, there is risk associated with that. I always give the example, if you look at a rose, there's about an inch of a rose, but there's about 2 feet of thorns, okay? So understand that we're going to be talking about that rose and the thorns, and talk about some past examples, some current examples. So we're going to take a look at market posture first. Then what we're going to do is we're going to get into existing positions of covered calls and sold puts that have been historically done. Talk about good ones, bad ones. Then we're going to talk about new potential examples of covered calls and sold puts. Now, again, this class is really focused on direction. In other words, picking a direction. Now, do we have to be completely right on the direction? No, we always talk about, for example, there's actually what we call 5 trends. This is up a lot, okay? This is up a little, okay? This is flat, slightly down, and this is really down, okay? So this class is really about, if we could get to where, if the stock goes up a lot, that would be awesome. Up a little, decent. Flat, that's still okay. Slightly down, we could be okay. The only ones that are probably really going to hurt these type of strategies is if the stock, okay, is really down. So we're trying to actually, if we could be right, let's say 4 out of 5 of these, we could be okay. Okay? But if the stock really goes down, like ExxonMobil, it could hurt these type of strategies. So let's, for example, just hop right in. We're going to start out with SPX, NDX. We'll take a look at, for example, the TNX, and we'll also look at the volatility. Now, SPX first. If you take a look at the SPX, you're going to notice that here was the prior high. This is right before the steel tariffs. Now, I know that's been the highlight of your last 2 weeks, the steel tariffs. Okay? And if you take a look at this, there's been some, what do you want to call it? Some recalling of words, or the tariffs will depend upon what you say at the offering table, right? And so a hard front was placed, but then you kind of see, well, it's not for our North American partners, okay? It's just for the Chinese. And so you can kind of see that the market has actually kind of factored that in, the price factored that in immediately, but you're going to kind of see that just like news, and we say this all the time, news is like wind. Wind doesn't last all the time unless you live in Oklahoma. Now, I have nothing against Oklahoma. I have family who lives there, but it does tend to blow a lot, okay? And what you're going to see in this case is the price went down, and just like news, it passes, okay? The price is actually pretty much really tested. Well, actually, this is higher than that pre-news, okay? So the SPX higher than where we were before that steel tariff, okay? Now, if you actually look at the SPX, if the SPX is actually up, now remember, the SPX, this is not an equally weighted sector fund here or an index fund. This is heavily weighted to technology. This is heavily weighted to actually financials. 35-38% of the S&P is in those two areas. If you add in discretionaries, you're talking about 45-ish% of the S&P is in those three areas of tech, discretionaries, financials. So what that would probably potentially maybe show is that those financials, techs, discretionaries probably aren't doing too bad. Those have been the three areas that we focus on the last 3 weeks, and we're going to continue to focus in those areas. Now the Nasdaq. Now hold on, one comment I really want to say on the Nasdaq. If the price gets above this high, what becomes the upside target? What becomes like the upside target? If we get past that prior high, what becomes the target? I mean, if the price breaks to a new high, is this a bearish entry signal? Really? So if the price gets past that new high, that old high, really the resistance on the SPX above us could really be, in this case, 28.32. Target area of, let's say, 28.67. Okay? This is what we call the path of least resistance. If you look at this right here, this is the up move. This is what we call short-term higher high with a pullback. Okay, this being like a higher low. Remember, the higher lows have the red and green candle. If you look at that not quite a bullish engulfing right there, but this right here is pretty dang close to what we call, that would be a close above the high of the low day, hammerish type of candle, and then you'll see a little thrust on the jobs numbers. Jobs numbers on Friday were not just good, but the past numbers were increased as well. Okay? It's pretty positive. Now, again, that gets factored in immediately. Okay? Almost immediately. I mean, depending upon immediately, right? I mean, you can only put in the orders as fast as you can. So, but those orders, you're going to see that really 400 or 40 S&P points on Friday, factoring in those better than expected jobs numbers. Now, the NASDAQ, we take a look at the NASDAQ just real quick. NASDAQ did break to a new high. Now, what index have we been focused on the last 3 weeks? What index have we talked about? We kind of said on a relative strength basis. We said 1, 2, 3. Okay? Now, which one do we say was really... Now, Roberto, previous high. Yeah, we're talking about the previous high on the SPX. If the SPX can get above that previous high, you could use a fib, okay, to maybe see an extension target. Now on the NDX, we said really the Nasdaq is really the index that has had the strongest relative strength. The SPX and the DGX. This is a continuation of what we said before. There's really no change. Nasdaq is still being considered where it has the strongest relative strength compared to SPX, compared to the DGX. The DJX is still lagging, okay? It is not even above that prior high. So I'm just talking about where the stock is in relationship to a recent high. Nasdaq is above all recent highs. SPX above the recent high, which goes back to the 227-day. And the Dow has yet to even come up to the 227 high. So those stocks in the Dow, some of them industrial related, kind of struggling a little bit. So there's no changes there. So sector's the same, indices the same as what we talked about in the last 2 to 3 weeks. Okay, so no changes. Okay, now let's go forward and actually take a look at a couple of these. So first off, one of the things that happened today, okay, when I came into the office, you're going to see that one of the I did see this. Okay. Came in today, and we noticed that one of the positions that got filled today, and I should really say exited, was WDC. Now, if you go to the Monitor tab and Account Statement, okay, so Monitor, Step 1. Step 2, Account Statement. Now, this is, we typed in the symbol WDC. Now, what this is doing is it's going back in this account, and it's actually looking for, in the last 30 days, to see when was this trade entered and or when was it exited. Okay? So it's just looking for WDC because we told it to. Okay? Now, what you're going to see is in this case on March 5th, okay, which was a week ago, this position was sold, and this position being a sell -1 WDC 20 April 18, the 87.5 put, that was sold for 283. Now this 283 has nothing to do with the commission. Nothing. Okay? That does not include the commission. This right here, you're going to see that this morning when I came into the office, it's going to, now that in red means that we sold it, and green means that's what it was purchased back for. Okay? 56 cents. So what you're going to see is it was sold for $2.83. It was bought back for 56 cents. Now, why was it bought back for 56 cents? Why was it? How come 56 cents? Where are we getting that number? Can anyone tell me where we got that number? Where do we get that number? 283, and then all of a sudden 56 cents. Well, 283 times 0.2 is just literally, if you take the premium 283 times 0.2, it would just get us to a target area of 56 cents and or lower. Okay, so that one was really, now this is a case where that trade didn't last very long. Okay, remember we talked about those 5 trends: up a lot, up a little, flat, slightly down, really down. Well, in this case, this was up a lot. Now, I'm not going to ask you a question of how many of you can handle that, because maybe some of you would. Not mine to handle up a lot, but what you're going to see is in this case, WDC really went up. I'm going to say, I mean, it went up about 10%. I don't know what's big for you, but they went up about 10% in the last 5 trading days. I don't know. What's a lot, okay? This is an example where this sold put, it didn't last. If you go back to here, this was an option that was all the way out to, let's say, 20 April, so it was about a month or so. And you're going to see that it didn't last very long. It only lasted a week. So this is why I always tell people the expiration doesn't mean that you have to hold all the way down to the expiration to get to the 80%. If you can forecast potentially that stock has maybe a breakout potential, a bounce potential, and that stock is bought up by other investors, you could make potential these type of gains could be quickly if the stock is bought. It doesn't mean you have to hold all the way down to expiration. Yeah, if you're trying to get a certain gain and the stock doesn't move, let's say it stays flat, okay, this is where you have to hold longer to expiration because the time you didn't get the direction. We're trying to really make the money from time. Okay. Now what I'm going to do is I'm going to hop right in. Okay. But I just want to give you a quick update on the WDC. That one was one from last week that was it was bought back this morning. Okay. Now let's take a look at, for example, okay, some past. What I'm going to do is I'm going to look at AAL. Okay. And I thought this was kind of interesting because I always try to show you a little fair and balanced view of good ones and bad ones. Now, you guys know that AAL has been in the doghouse for a while. Okay? Now, what was that? Now, what you're going to notice is sold the put on really AAL, probably about right there. The stock completely went down. And if we go back to that monitor page and you look at, for example, in that list of sold puts, AL that was negative, okay, has now worked its way to being positive. Now, it was probably down $1,000, $1,200, and it is actually now sitting here about 151. Now, there's still 67 days left here. So just like we said the last week and the week before and the week before that and the week before that, I mean, sometimes if you sell these far enough out, they could reverse. The key is could. It doesn't always mean they would. They can. Just look at Exxon. Exxon is not showing reversal, but you're going to see that went for a very interesting ride where it sold down and it's come all the way back up to where it was previously. Now, if this was a stock position, you'd be trying to get back to break even. But since this has burned time, you're going to see that there is some premium that is gone. In other words, the current price is lower than the premium because there's been time that is elapsed. Okay? So really on AAL, we're just going to kind of let it go. Now, one of them we're going to actually look at just real quick is Amazon. Has anybody been watching Amazon at all? Now, Amazon, if we take a look at this, this is really what we call a short put spread, okay? This class is not on short put spreads. Short put spreads is really selling a put and buying a put. Selling a put, which was the 1400, that was 2390, and the 1390 is really acting as a stop. Now, what you're going to notice is this would have been awesome had we just sold it for 2390. But you have to remember is if you sell a put, there is an obligation, okay? And we said, man, this is a super, super duper expensive stock. Could we maybe just, for example, buy a put just in case where we don't have the risk? We have a built-in stop loss, okay? Which was the purpose of the 1390. Now, what's happening is we're really making the difference between these two less the commission. Now, I've also thought about this a little bit, and I want to ask you a question. Okay, so on AL, I'm just kind of letting you know that's still playing itself out. Okay, we don't have enough profits there, 50, 65, 80%. It's just kind of going from loss to slight profit. Now, I want to ask you a question. Okay, when do you tend to have 50, 65, 80%? When do you tend to have those percentage gains? Is it when the stock is in the pull, which is price appreciation? Or do you tend to have those 50, 65% of the gains, 50, 65, 80% of the gains when you're in the flag portion? Does anybody know? When do you tend to have an opportunity to profit take and or roll the position? When? Is it in the pull? Doink! Or is it in the flag? Give back. When? Now, I want you to think about this. I was talking to someone, and I don't think they realize when they tend to have the profits. Now, think about a typical bull flag pull. How long is it typically? Some technicians, they look at it as a bull flag pull. A typical length of time on a daily chart might just be 5 to 7 days. Always? Of course not. You know what's better than that. 5 or 7 days. That might be a general gist. Okay, this one right here, you're going to see 8 days, 8 bars, so about 8 trading days here where the stock has just gone up, 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 day after day after day. Typical pull, 5 to 7 days. Shorter term bull flag, or pullback, I should say, pullback, if the stock is above the 10-day moving average. That green line might be just be 2 or 3 days. Always? Of course not. Shorter term flags, longer term flags. Think of these pullbacks as short-term higher lows. Now, you're going to see that in the last couple of days, we've actually seen little 1-2-day pullback. 1-2-day pullback. 3-day pullback. This type of price behavior is it could be found when the stocks are above the 10-day moving average. This is pretty normal if the stock is above the 10-day EMA. Okay? Now, so if someone has an opportunity to profit take, what this really actually means is the stock is probably in the pull, in the price appreciation. Now, first of all, do you realize that? I want an epiphany to come over you. This is really what I'm trying to say. Do you understand that? If you profit take at a 50% or 65%, or you can profit take at 80%, that is probably because you are in the pull. Now, if we do profit take, and what you'll notice is if you look at the sold put, which is really the driver of this position, do we have 80% gain on that sold put? Is there really 80% on that premium right there? Okay, now, you could do the quick and dirty math. We could also just go to setup, application settings, and just say, could you do the math for us? Okay, could you just show us the percent open? And if we look at that, you're going to see that that is a 94% gain of the max of that premium. Okay, now if you take a look at this, the mark, that bought put, still has $1.13 left. Okay, so it's not like this is only 3 cents. We're going to actually click on this. So option number 1, you have 17 days left here to expiration. Option number 1 is the money you can make left is called the extrinsic value. The extrinsic value. So what the investor could potentially get is the $1.25. But you have to also factor in what's the extrinsic value of the put. Well, you could actually literally make, if you could make $1.25, but you could lose potentially $1.12, how much more could you potentially make even if you waited the next 17 days? Now, this is very important here. Very, 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 very important. If you could potentially make $1.25, if it stays where it is, but then the put loses $1.26, how much more could you really make, assuming that the stock stays right here? Where? How much? What's $1.26 minus $1.12? Well, that's going to only be 14 cents or $14. Now, here's the question. So if you just subtract these two from each other, you can make a whopping $14. Now, here's the question I'm going to ask you. Okay? Now, I am allowed to ask, one simple question. Here's the one simple question. This is it. This is the fat softball here. Okay? So right now, there's a profit of 226. And there is, okay, so you have a current profit. Okay, this is prior to commissions, 226. Existing, or I should say remaining extrinsic value is $14. Okay, so I'm going to ask you, think of your reward as $14 and your risk is the 226, which is the profit, plus max loss. Now, do you want to risk the 226 for $14 and the max loss? Do you want to risk that? Do you want to actually say, I'm going to stay in here for that last $14? I'll risk my 226, potentially the stock could go down, and I'll risk to the max loss. If you look at the reward risk ratio on that, it might be a reward risk ratio of 1 to 10. Okay? You're trying to make $1, but you're risking 10. Okay? Now, one of my good friends was actually down there in Vegas. She went to a casino. And the next day I saw her at a soccer game. I said, man, what happened to your pants? And these pants were slid all over the place down the front of the pants. And she goes, this is the comment she said to me, quote, James, I didn't understand the reward to risk ratio. These pants are a reminder to actually remember what the reward is relative to the risk. So these holes in my pants remind me, okay, of the reward risk. And I thought it was just funny because I never thought of it like that. Now, if you look at this, let's go ahead and actually close this down. Now, option number one is take the profit. Second could be if you said, James, I'm going to hold the position all the way in to try to squeeze that $14. That could be option number two. Right click, create closing order. We're going to buy that back. Now, this vertical here, we're saying, look, buy the short put back, the 1400, sell the 1390. And this is what you're going to see as the 14 cent debit. How come it's a debit? Well, when you entered, it was a credit. When you exit, if you're trying to do so for a gain and or a loss, it's for a debit. Okay? Confirm, send the order. Okay? Now, if we go back and really look at that order is sitting there, we'll see if that order cannot fill. Now, I'm going to go back into this. Now, I know that this class is not on short put spreads, but I think this is going to be the one stock that we look at for an example for selling a put, but just to be mindful of the stock price, we're going to buy a put. You sell a put, you buy a put. That's called a short put spread. Okay? You probably understand where I'm going anyway with that. Now, let's go down. Let's go look at, let's say, 30 to 40 days to expiration, that date range. Now, here's the deal. When you sell puts, the investor can determine how close to the fire or the current stock price are you willing to get. The higher the delta, greater the probability to be in the money at expiration. Okay? Higher the delta, fatter the premiums. Okay? Now, there needs to be kind of a balance between premium and risk. So many options investors might go down to, let's say, a delta between 30 to 40, might even go lower than that to increase the likelihood that a stock might not close down there, but the con, they don't get as much reward. Now, let's go down to something like the 15, let's go all the way down to like the 1545 with a 30 delta. Okay? So here it is. Now, the idea is we're trying to sell a put where we think the stock could stay up above that area. Okay? So wherever you sell the put, you're thinking, hey, I think the stock could stay up above that area. Of course, there is a probability associated with the stock closing below there, and that probability is pretty much within 2 or 3% of that 30% number. Okay? So it's telling us that delta is saying there's about a 30% chance of the stock closing below 1545. Now, if you want more information on that, we talked about that historically, Sheldon Natenberg's book, Price, Time, and Volatility, page 102. Okay? If you want to get super, super, super detailed, you could look at probability of expiring in the money. That number is going to be within 2 or 3% of delta. Just for time's sake, I think that delta, it's going to be close. Okay? Now, if we right-click right here on that bid, go to sell vertical, okay? Now, what we did before is we opened up the strike really about 10 points. So if we sell the 1545, we're going to go down and do the 1535. Now, someone doesn't have to do that. We're just going to open it up 10 points wide. The credit here is 262. Now, this is where the math becomes pretty simple, because if we have to buy the stock at 1545, but we have a right to sell it at 1535, that's a risk of $10. So if we risk 10, but we collect 262, that if we go confirm and send right there, it's going to be a maximum loss of $10, the spread, minus the max profit. So even if the stock went all the way down to zero, the most we can lose, this is defined risk, you're going to see is 738. Now the buying power effect, quite different here. Okay? Buying power effect, 738. This is not like $500,000 that sell one put on Amazon. What makes it where the buying power is lower is we're buying a put where the risk is not down to zero. The risk is down to the long put strike. Now what you'll notice is we're trying to really make 262, where we have a max loss of 738. That reward risk is about 1/3. Okay? Some call that the return on risk. Okay? If we go to send that order, okay, that's sold. And let's go back and look at this just real quick. So if we go back and look at the position, you're going to see that the one that we actually just did was the 1545 and the 1535 right there. Yeah, many investors will take that premium, okay, and they'll divide that by the risk. So if that premium was, let's say, 262 and that max loss was 738, just quick and dirty numbers, they might say, hey, type in 262 divided by 738, and that really gives an ROR, return on risk, of about 35%. And the investor is really position sizing for maximum loss. So if this portfolio could take about $1,000 of maximum loss, it would really be one contract, which is what the paper money account did. Okay? All right. Now, let's go back. Now, some of you want to talk about MU. I could feel it. Now, MU, okay, Micron, which actually is kind of interesting. It's on the other side of the hill from us. But if you look at Micron, Micron got upgraded by, Nemera, I think it was Nemera, upgraded it to $100 price target. Now, when analysts maybe give a price projection, okay, it doesn't mean that every analyst gave the price projection of 100. But obviously one of them gave a really high price projection. Okay? One of them. How many analysts cover Micron? More than one. Okay? And so, but you're going to see that with that high price target, what that's really done is it's caused some investors to speculate. Okay? Now, when I look at a stock like Micron, some people always talk about earnings plays. Like, I'm talking about within the week of earnings, they're going to talk about earnings plays. I think many investors might want to consider going back even further than, let's say, inside the week of earnings. Many technicians will go 3 to 4 weeks prior to earnings, and they'll start to look for stocks that are maybe breaking the resistance 3 to 4 weeks prior to the earnings. This is where investors could be speculating that the earnings could be good. How do they know for sure? They don't. They're speculating. Okay? Now, if we go back and actually take a look at MU, let's go back and look at this. You're going to see that in this, we have really the 49 put right here. Okay? The 49 put. Now, if we go look at this, you're going to see that this one right here has a 57%. Now, this was done last week, same thing. You're going to see that it was sold for $275, and what you're going to see is the mark value is $117. Now, hold on here. So first off, 57%, this is obviously an example of something that went up really high. Not as likely, okay, but it did. Doesn't quite have, so if your goal was 50%, you might say you've reached your objective. If you said, James, my target is 65%, not there yet. 80%, not there yet. Now, I just want to review, this is where it's important. If we look at the price, $275, I just want to review where that buyback order is, okay? Now, what you're going to see is it's saying buy this back at 55 cents or lower. Again, where is that number coming from? It's just taking the premium times 0.2. Okay? 0.2. So it's not there yet. So the stock really, the option price, 117 down to, and this one actually right here is not supposed to be there. Okay? So this right here is, this needs to really drop down to about 55 cents. This meaning the premium for the sold put. Okay? So that one is still in the oven. Now, if we go back and look at maybe, so most of these, if you go back to the worst one that is in the inventory, okay, when you look at all these sold puts, Love is still kind of sucking, well, it's sucking air, okay, has 4 days left to go to expiration. The stock is at 62, the strike, excuse me, is at 62.50. The stock is at 60. Now, if this stock starts to go up a little bit, we might still be above break even at expiration, but we would probably need the stock to go up quite a bit to get back up above the strike. So if this stock closes below that put, could be the owner of the shares. Or if someone puts us the shares prior to the expiration, we could be the buyer of the shares. So really, if you look at, let's say, Love, last one on this, you're going to see that Love has really been in a basing pattern. One bottom, two bottom, and what you're going to see is a nice little short-term higher high with the moving average crossover. So if you actually look at this and say, look, if someone put me the shares, it's like entering a brand new position with 300 shares on a moving average crossover, on a brand new recent high. So someone might look at that and say, sure, I'll buy those shares. Okay. Now, what we said before, we're going to plan to hold this all the way to expiration. Let's look and remind ourselves, what is the obligation? The obligation is to buy the shares at $62.50 less the premium, and it's $62.50 less the premium of $160. That really means we're going to be the buyer of the shares at $60.90. Now, if you take a look at this, $60.90, and the stock's at $59.90. That really means that the stock is $1 below the break even. Okay? $1 below break even. All right. So now let's go to talk about some. So those were some. We talked about AAL. We talked about Amazon. We also talked about Lev. Okay? Now what I'm going to actually start to do is going to take the last 20 or so minutes, talk about some new potential examples of covered calls and also selling puts. Now, the one we're actually going to look at is we're going to go to NVIDIA. Okay. Now, if we go back and look at NVIDIA, okay, go back and look at this, take this off. Here it is. What type of price pattern do you see on NVIDIA? Kelly, I'm going to come back to your question in just a sec. If we look at NVIDIA, what type of price pattern do we see on NVIDIA? Okay, that's an ascending triangle, right? You get really two highs. You get really upward trending support line. Whoop, something like that. Okay? Now, how do you know the price is going to break out? We don't. Okay? How do you know the price isn't going to come all the way back down to the bottom of the diagonal line, maybe bounce up again, maybe burn off sometime? We don't. Okay? You're really doing a probability-based trade. If someone looked at this, someone might say, James, I could see potentially the diagonal support at 230. Okay? Some investors look to sell the puts maybe at where they think the support level is, or sell the strike below where the support level is. Now, if we take a look at this, if we go to the trade page, the investor now picks, okay, the investor now picks what strike or what expiration do you want to do. Now, if we go look at this, I'm going to just take this and say, okay, what do we have? We have weekly options, monthly options. We're going to show an example where we go farther out in time. Let's say 70 to 100 days, 95 days to expiration. Now, the diagonal support line that we have drawn was down right and near the 230 strike. The 230. Okay? Now, what you're going to see is in this case, that premium, so this is a 30 delta, and you're going to see that the actual premium is 1150. Okay? The ROR is about 5%. Again, if we're talking about 1.5%, that would be low, 2.5% would be medium, 3.5% would be high. This would actually tell us that the implied volatility is higher than probably a lot of other stocks. So 1.5% low, 2.5% medium, 3.5% high. This is 5.29. So it tells us that implied volatility is actually pretty high. Okay? Now remember, if you take a look at this, the delta, that's saying what's the likelihood of the stock closing below the strike. And one very, 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 very important term is called the probability of touching. Okay? So what this is really saying is, what is the likelihood of the stock going down to the 230? It's a 71% chance. Now, why would you care? Well, if the stock goes down, that means that the put prices go up, and then you could be in a loss initially. Okay? So you have to understand that just because we're selling that 230, it doesn't mean, it's not going to come down. No, there's a 71% chance it could come down. What does that mean for the investor who sells the put? It means that that position would be upside down. If they bought it back, they could be losing. Okay? Now, what we're going to do is we're going to right-click right on that 230. We're going to go to Sell, and we're going to go Sell Custom, and we're going to go with Stop. Now, this is where you have to really determine, do you want to set a buyback? Okay? Remember, we talked about if you're setting a buyback of 80%, this is where you're going to take that premium times 0.20, and in this case, it would really be about 226. Okay? So, if you're trying to get 80% of that 1135, take 1135 times 0.20. It's going to get you to about 226. Now, if some of you say, James, I don't set it that high, I go for example, a 65% target. Well, then take the premium times 0.35. Okay? Now, if you take 1135 times 0.35, you're going to see that that would mean that the premium, okay, would be 397. Okay, so these are the targets. Now, can I ask you just real quick? Do you go for like a 50% target? Do you go for like more than that? 65, 80? What do you go? I just want to kind of see where you are. Now, I'm going to write this down. So this is the initial premium, okay? And you're just taking that number, timesing it by 0.20, times by 0.35. Okay, so a lot of you are doing 65%. So if you're doing 65%, that investor might say, look, take 1135 times 0.35. Now, in this case, we're just going to take that, and if we said in this paper money account, we're going to send an 80%. Let's show a little variation. Let's say we want a 65% target. Now, if we took 1135 times 0.35, it's really 397. Type this in, 397, stop day GTC. Now, I want to kind of go with what you're saying. Why might that not be a bad target? The farther that you sell out in time, the less probable it is that you can get 80% of the premium because there's still the time left. Some investors, might lower those price targets, and that looks like what you're doing. Okay? Now, if we go back and go stop limit, okay, this is a limit. This is saying we want this price or lower. So the investor is really trying to sell here and buy back here and or lower. Okay? Now, you have to understand that the stock could get put to us. Many investors don't want to have maybe 10, 15, 20% of their portfolio in one position to be prudent. Okay? If we said, hey, James, if these shares were put to us, well, this is a $230 stock times 100 shares. This would be a $23,000 position. Okay? Now, James, why do you always speak so much on negative? Look, I have 4 children. I have to think negative. Every day, okay, when they call me, I'm like, what happened now? Okay. Caleb calls me, Dad, fender bender on the car. What happened now? Zach tells me, Dad, I'm always thinking risk, hence 4 children. Okay. Now, if we had these shares put to us, 23,000, okay, what size is the portfolio? Well, the size of the portfolio is really $511,000. Well, what size of the account is that? Okay, 23,000 divided by 511. So what this would really mean is this would be about 0.045%. Now, for some of you that find that a little tough to read that, it's 4.5% of account value. Okay? Now, please understand that we are going in fully understanding that stock went down and they put those shares to us prior to expiration. It's going to be about 4.5% of the account value. Okay? If we said that we could actually do up to 10% of the account value, then we would go 2. Okay? Because we're not doing more than 10% of the account value. Now, you might have some different metrics that you use. If you said, James, I only do 5% or lower, it would be 1 contract. If you said, James, I can do up to 10%, it could be 2 contracts. In this example, we're going to take 2 contracts, and we're going to go confirm and send. Send that order. Okay? So there it is. Now, let's go back to, for example, one of the stocks that we discussed last week. Has anybody been watching Square at all? Now, we talked about this quite a bit last week. Has anyone, for example, been looking at Square? Okay? Now, I don't know if we would say it went up as much as WDC. That's not really the point. But, both kind of look like they, from last week to this week, they went up directionally to the right. Okay? Now, what you'll notice is Square, when you go back and look at this on a weekly time frame, and oh my gosh, I sure hope you are starting to look at those weekly charts, okay? Very important. Price patterns are applicable on weekly charts. Candlesticks are applicable on weekly charts, okay? See the bigger picture. Now, if you look at this from last week, you'll see that this was really a large green candle, okay? And if you take a look at this on a daily chart, go back right here. Now, what we're going to do is also go look to, for example, let's go to SQ. Now, I don't know how, if you guys have thought this and gals have thought this about this lately. There are a number of stocks that look very interesting, but they have become really, really expensive. Has anyone noticed that lately? That some of these stocks, like you go look at them, and it's like, this would be awesome if you had a 6 or a 7-figure portfolio. A lot of these stocks have become quite expensive, okay? Whether the Dow specifically and or NASDAQ, okay? Let's look at a $50 stock, okay? Now, we're going to go actually to the trade page. $50 stock, okay? $50. And so now let's go to, for example, let's say we want to do something, James, I don't like that 70 to 100 days. I know it's bigger premium. The time decay is slow. It's a more directional position per se, okay? But let's say you want to go down maybe in that that date range of 30 to 40 days. Okay. Now, that didn't quite pull up there. Let me bring it up. Let me just change those, sync those. Sync. There we go. Okay. Want to actually see if I can't sync those. Yeah, it looks like someone actually changed those. So I'll just keep them the way. I just want to make sure they are what they should be. And it looks like, okay, we're good. Now, so let's go 30 to 40 days. Still looking at the April, the weeklies and or the monthlies. Now, if we go, let's say, the 20 Aprils, okay? Now, the first thing you'll notice, if you go about 40 or so days out, this number, again, is the annualized volatility number. They're saying that this stock could go up or down 43% for the year. Up or down 43%, okay? Now, if you take a look at this, you're going to see that this is how much the stock could go up or down for the month. Okay? Now, please don't just look up, look down too. Okay? So this is up or down. That's a plus and or a minus. Now, if you take a look at this, if we go down to that delta, let's say 30 to 40, you're going to see, now look at the differences here, okay? I want you to notice there's, on the monthlies, there's really strikes 50. Well, there's really nothing at 50. Well, there's nothing at 51, 52, 53. There's just 50. And then it goes 49, but the problem is that really drops into a delta of 20. If we go to 13 April, you're going to see there's a little bit more selection here. Okay? Please understand, if you were given the opportunity to actually have more strike selections or less strike selections, many would potentially pick more. You might make in your watch list criteria, I want weekly options come heck or high water. Why would the investor want that? They would want that because in a situation just like this, it's not really giving you a whole lot to consider. It's really like if someone says, I'm looking for a delta of 30 or 40, there's only one of them. If you go to the weekly options, Here's a couple more that you could consider. You got the 51.5, the 51, the 50.5. This is where it gives the investor the choice. What strike do they want to sell? Let's say we sell something in the middle between that delta of 30 to 40. Okay? Now, if we go look at this, we're going to look at the 51 strike. Let's look at what the ROR is. Okay? Now, if you're saying what is really the ROR, remember that stands for return on risk. That is, if you take the premium divided by the stock price. It's about 3.3% or so, plus or minus a little bit. Okay? Decent premium. 1.5 low, 2.5 medium, 3.5 pretty good. This is probably telling us that implied volatility is pretty high. What's the ranges on that volatility? 15 would be low, 25 medium, 35 high. So if that number is in the high category or range, it's telling us that ROR is probably pretty good too. Now, why does an investor care? Well, the higher the premium, the lower the break even. So if an investor sold the 51, this being let's say we got somewhere in the middle, let's say like $1.68 premium. Well, this really means that the break even expiration is really $49.23 if you subtract those. The 51 really being the strike, the 168 being the premium. And where'd you get the 168? If we got somewhere in the middle. And this is what we call the break even at expiration. That's not break even tomorrow, today. That's at expiration. Now, if we go take a look at this, let's assume that in this account, each position could be up to $20,000 worth. And for every 100 shares we bought, it was $5,100 worth of stock. Safely. How many contracts could we really do here? Safely. If $20,000 was the capital size, $5,100 is if we bought 100 shares at the $51 price. This would really be 3 contracts. Okay? Now, let's just go and evaluate. If we right-click right on that bid, right-click, we're going to go down to Sell Custom and go with Stop. Now, what this does is let's change this to 3 first. 3. And this becomes pretty simple math here. Now, wonder if you said, James, and I'm going to take this number out so we can just kind of keep using that. 160 is that initial premium. Let's say you wanted an 80% target. Well, this gets pretty easy now. $1.60 times 0.2. And what that really is, it would be 32 cents. And that is going to be 32 cents. That is not a stop. That is a limit day to a GTC. Okay? Again, does someone have to set the buyback order? No, they don't have to. But if you're saying, James, my goal is to make income. And whenever you have, where you have gotten the huge chunk of the reward, let's say 80% of it, and you can only make 20% left, you're realizing that that reward-risk ratio doesn't look very enticing. And you're realizing that. And you take it down. You're saying if that option price were to drop to 32 cents and or lower, you're saying get me out, let me have the potential to roll and or establish a new position. Now remember, if we go back and look at the chart, where's the 51? Selling the 51 is pretty much about right there on the chart, 51. It's probably right near where that 10-day moving average is, okay? Remember the break-even expiration, when we come back and look at this, that break-even expiration is at 49.32. 49.32 is going to be at about right, I'll zoom in, about right there, okay? So this is where that's the strike that we're selling, for an example. This right here is the break-even at expiration. Okay? So if the stock were to come down some, again, this is very important you understand this. If we have a situation where the stock trends up a lot, the profits could come a lot sooner. If the stock goes up a little, the profits come a little slower. If the stock is flat, we're really relying upon theta, okay? Relying on theta, contraction of volatility, okay? This is where we're actually making direction, or delta, theta, and vol contraction, okay? Same thing here. This is delta, theta, vol contraction. But it's just really, in this case, it's less, okay? Less. Now, if that stock goes down, this is directional risk, okay? This is what we call the numbing of time, or theta, and this is where we get the vol expansion. And the same thing on the downside, okay? Same thing, but now it's even worse, okay? Now, again, we know that if someone were to ask you, what one do you want, up a lot, up a little, flat, really down, clearly the investor wants up a lot, okay? That's where the three factors, direction, time, volatility, contraction, could really benefit that investor. Here's the deal. So if someone could be using sold puts as a strategy to just play directional type of positions, but just where their deltas aren't as high as if you own the shares. Okay? Now, got about 3 minutes left. So sold those. Let's in the paper money account, go confirm and send. Okay? And that, again, position size for the account size. Okay? And we talked about the likelihood of the stock going down below the strike and that break-even expiration. Now, let's take also a look at one more. And I'm going to pick, for example, Apple. Got about 2 minutes left. What do you guys and gals see on Apple here? Now, I'm going to that's a question I probably won't be able to get the time. But if someone looked at this, they might say, well, James, could this be viewed by a technician as a breakout on Apple? Okay, could someone maybe be forecasting, maybe like from the bottom of this V pattern, maybe take the bottom of the V pattern, let's say 155, up to the resistance about 179. Could this be like a price projection of $25? Okay, could this pullback be also like what they call a handle? Could this be like a cup and handle? Now, again, this all sounds rosy. It's a projection, okay? Some technicians could take that bottom to the rim of the cup. That's where we're getting the 25. Some investors will take this and they'll say, James, this rim, go to the pullback area. Here, this is what they call the handle. Okay? Now, let's go back and look at this. So it's a cup and handle type setup. That's a key word. It's a setup. Okay? Doesn't guarantee anything. It's a setup. Stock could still go down. We can have an analyst come out tomorrow and say, we think the price projection is 150. Absolutely. Okay? So in looking at the setup, if we go back and let's say kind of show an example, let's kind of show, we did a little variation. Let's say we go look at the maze. Okay? Now it's going to give us about a 180, 175. Now we chose an example of going farther out, shorter dated. Let's go somewhere in the middle so we show a little variation, but still picking a delta range between 30 to 40. Now if we right click on this and go sell and then go with stop. Now remember, this is our third one here, okay? The only difference really is the variation of expiration. There's pros and cons. The deltas on all of these are between the delta range of 30 to 40. They're really near a support and or below the support because the idea behind selling the puts is the investor's trying to buy the stock at a discount, hence lower than the current price. Now, if we take, for example, the premium, 420, let's just, for quickness, 420, okay? We could squeeze that 425, maybe on the mid. Let's just keep the math easy, okay? Now, let's say you said, James, my target, okay? I'm just taking the words out of maybe someone what they're saying or thinking. If we take 420 and we say, let's say your goal is 65% of that target. Well, if your goal was take the premium 420 times 0.35, it would really actually give that target about 147. We took the premium times 0.35. And what this is really going to do is it's going to give us a target buyback level of 147 or lower. Now, if I take that number, 147, there it is. Stop, no, limit. This is saying 147 or lower, day to GTC. If the position size was $20,000, you could really only do one position. Now, we couldn't put that in time, but let's say tomorrow morning it opens up. If we go confirm and send, let's just read, we missed the 2 o'clock deadline. Selling in the paper money account 175 for about 420. Gonna have to see if this fills in the morning. Okay, buy one. Okay, trying to buy that back at 147. So if we send that, again, same probabilities, 66% chance of being below, 33% chance to be below that, 67% chance to be above. The ROR is about 2.5. This is a little bit more medium. Okay? All right. Now, what we're doing is over time is we're just building an inventory. Why? Well, we're trying to actually build income. We're trying to also do trades that aren't so directionally based. If the stock goes up a lot, a little, sideways, maybe somewhat slightly down, that might not be that bad. But the way that these type of strategies get hurt is if the stock goes down a lot. And Exxon is still one that is the example of kind of bad. Not horrible, but it is down. Okay? There's some time left. Now, I'm out of my time here today. Okay? When we talked about the example of Apple, we'll look at this a little bit more tomorrow. And again, just because it has maybe a cup and handle type pattern, it's a forecast. Now, if a lot of investors start to speculate or they're reading the same thing, the stock could go up to that expectation. But no one knows ahead of time if it's going to actually go up to that target. It's a forecast. Okay? So with that said, I'm out of my time. The 3 examples that we actually talked about here today was, we got Apple. When we actually go, let's look at the filled orders. So the example we actually did was Amazon, NVIDIA, Square, and really Apple. So we did 4 examples, okay, today. Now tomorrow, so tonight at 7 p.m. Central, I will do a class on long synthetics tonight, okay? That's at 7 Central. We'll also teach the class tomorrow on Technically Speaking at 1 Central, okay? So check that out. Now, in order to demonstrate the functionality of the platform, we're going to use actual symbols. We did. TD Ameritrade does not make recommendations. Understand that with those premiums, there is risk. Any investment decision you make in your self-directed account is solely your responsibility. And also, remember that Delta, Gamma, Vega, Theta, talking about the sensitivity to direction, volatility, and time. And I think we handled that, talked about that quite a bit. Probability analysis it's mathematical. It's theoretical in nature. It's not guaranteed. And those probabilities can change. Okay, so with that said, this has been the class on cover calls and cash secured puts. Showed an example of 4 cash secured puts here today, and we will continue to follow the inventory that we actually have in the paper money account, and these are paper money trades. Thank you so much for your comments, your questions, and your participation, and I'll see you tonight. Take care. Bye-bye.